Hey everybody, it's Bob. My good friend Phil here, Trade Genius. Hey, buy now, sell later market. Negotiations are ongoing with the government shutdown. Market was looking for a relief rally. They're getting it. Stay tuned.
Trade Genius.
Hey guys, I want to tell you something that we do that really will change the way in which you look at trading and also absolutely help you increase your profitability and how much money you make. It's the Trade Genius newsletter. We put the newsletter out Sunday night through Thursday night, and this really looks at the plumbing of the markets and helps prepare you for the next trading day and help you make money. And we give you a lot of information. We give you market statistics, we give you market levels, we give you the seasonality, what's happening with different sectors of the market, and we will help you identify whether the market's in a bear mode or a bull mode, or whether it's euphoric, whether it's despondent, and it just puts you in a position to be on the right side of the trade. So take advantage of our offer that we have below, and you'll love it. I mean, one trade that you make with this thing can pay for definitely a month, maybe even a year's worth of service. It's that powerful. Use promo code podcast for 15% off the retail price of newsletter. Thanks for listening.
Okay, Phil, we've been waiting for this sell-off to abate, and they're looking for an excuse, and they got one from Washington, D.C. Walk us through it.
Yeah, so, we'd been warning that things are getting really oversold. We've gotten a late, sharp rally reversal here on the markets, and it came off the heels of Mitch McConnell saying that they are going to work to avoid a shutdown, which I think is the first real material thing we've heard recently. So in terms of the government shutdown, I thought we'd go through a few charts here. One is, this is what it would look like if we were to get a government shutdown here. Basically, you're close to a million jobs lost, or at least temporarily offline, which is not what this market needs. Now, in terms of historical precedents, we had a similar situation in October 2013 and in November of 1995. So in terms of the macro, it doesn't really affect the markets a ton. You're going to get, maybe a red month, which I think we already have going on here. But then market typically recovers because it's just a game. The pressure gets put on and they capitulate, and then we're back, back to regular business. But the consumer afford that kind of, even if it's temporary, that kind of job loss? I would say no. Here's the first 3 weeks of September when it comes to credit card spending. We had a back to school surge. It's given all that back, and now we're dumping again. So you have that. So that's a real up to the minute pulse on what the consumer is doing. And then, Bob, if you look at this, we have excess savings depleted for the bottom 80% of households. Again, we're a consumer economy, and now we're relying on all these guys to run up the credit cards. And I won't even bring up the credit card graph. We're peaking out here in terms of everyone's credit limit, especially for that lower half of the economy. So we got the depleted savings. Credit card spending is dropping off a cliff after the after school surge. So I don't think it's going to be very good if they do go into a government shutdown. Now, that being said, I think we do have a short-term bottom that was put in here. The oversold levels here, guys, on breadth, if you guys get the newsletter, which I encourage you to do over at tradegenius.co, sign up for it, you'll see we are hitting extremely oversold levels on things like breadth and some other technicals. So don't be surprised if we see a 200 to 300 point rally here. Now, do you go in there? No. And the reason for that is this next chart. So while you can enjoy a short-term rally, these are not levels that you want to be allocating long-term to. And what we're looking at here is that orange line represents corporate credit. And actually, it's the S&P 500 divided by corporate credit. So it's the ratio of SPX to corporate credit. And as you can see, we're at levels that we were at the dot-com bust. And what that basically tells you is that, when yields are low, when interest rates are low, they can borrow cheaply. Corporations can, right? They can put that money to work. They can do stock buybacks. And a lot of times the stock buyback phenomenon fuels this market for the long term. So as you can see here, it's no longer cheap to do buybacks. It's no longer cheap to borrow money and expand. This is what the Fed wants. They want everything to contract. So there's your skull and crossbones at danger levels. You don't want to be buying in your portfolio long term when this is over 1.3. We're currently up here at almost 1.5 now. And so this typically will signal a long-term pullback. And you can see how that performed back in the 2000s. In 07, we didn't even get remotely this high, and things fell out. Now, it's a different situation in 07, but Bob and I have told you a number of times, we think we're more closely aligned with the dot-com bust, especially with this AI bubble thing that's happened. So you want to wait for that thing to get back down to that level down there around 0.65 or so. And that's a great level to go long-term. And I'm talking long-term into the rest of the decade type of allocation. So Bob, I think right here, right now, looking at the short term, We got a nice pop probably in the making. Longer term though, you want to just not be don't buy into this pop that we get, because I think we're slowly, as we progress through Q4 and into 2024, I think the reality of a recession kicking in here is going to start affecting people.
Yeah, we're going to get another lower high. So, how we're playing it, look, I've been telling people, until I'm blue in the face, I'm long energy, short tech. So I took all my shorts off. I went long yesterday, actually. So I was a day early, but I'm already positive because of the levels that Phil pointed out in the newsletter. But oil is breaking out, and the energy names are still doing very, very well. They're ignoring seasonality. That should get your attention. Unless this is a breakout, fake out, it looks like oil has a date with triple digits before it burns itself out. But on the general market side here, I think, if things go as we think they're going to go, you get the levels from Phil in his newsletter, but I'm looking at a move that maybe will take us to Tuesday, and then the market's going to have to start thinking about the earnings reports that are coming out in October. Then I think we're going to go ahead and make a lower low. So we have a gap to fill up here at 437, 438 on SPY. Then I think we're going to make new lows, and we could fall all the way down to 400 on SPY, Phil. But that's a conversation for another day. Enjoy this relief rally. They're never one day. We put a massive hammer in, and if we get follow through tomorrow, then I expect there's going to be follow through the weekend, and that usually carries over into Monday or Tuesday of the following week. And we have seasonality of the first week of the month, the first day of the month, as bullish. So that's what I'm thinking, Phil. Pretty exciting. Like I said, we're still macro major bearish, but these relief rallies can put a lot of coin in your pocket. And if you're just long only, look for opportunities to get rid of the stocks that have been lagging here, and that you can get out of them at a higher price, because we will make a lower low before we see Mr. Santa at the end of the year.
What do you guys think? We're going to rally for a few days. We're going to keep dumping. Let us know your thoughts. Otherwise, we'll see you guys on the next video. Please hit like and subscribe and smash that notification bell and set it to all if you can. It really helps us out. As well as check out our specials and newsletters over at tradegenius.co. See you on the next video. Take care.
Trade Genius.